Good afternoon, ladies and gentlemen. This is Jesse Colombo, Cyber Trading University's Forex and Futures instructor, and I'm excited to have Vlad Karpel of Tradespoon on today for our Closing Bell webinar. He's going to be teaching us key trading metrics, return on capital, probability of success, and estimated move. So he's going to be basically teaching us how these metrics can help options traders make trading decisions more clearly. He's a 15-year trading veteran and also founder of Tradespoon, and he's going to be highlighting the critical elements of these metrics and makes the math easy to understand. So that'll start in about a half an hour, and until then I'm going to be doing my daily market update and analysis. So let me just get my charts up 1 second. Here we go. All right, so we had a little bit of a pullback today after such a powerful surge for the past few days in the U.S. stock market. Even though today we had a very strong housing start report where housing starts jumped to 7.5-year high, and also housing permits, construction permits soared. But at the same time, technicals and basically profit taking caused the market to pull back a bit as well. So it seems like the market's experiencing a little bit of indecision right now. Let me just draw my lines. So it's still above that support level, 2,120. It broke above, rose earlier today, and then sold off toward the end. So, but at the same time, it's still healthy because it's above this support. I just want to see if there's going to be further follow through over the next few days or the rest of the week. But so far it looks good. It's not surprising to see a little bit of a pullback after a big surge, but I just want to see that 2,120 support level hold, because if it drops below there, it would negate the bullish breakout signal. Let's take a look at the Dow. The Dow is above the 18,280 support. That's the late February high, early March high. You can see this looks like a doji candlestick pattern, so it shows that there's a little bit of indecision, but that's not necessarily a bad sign as long as it's above that support level and can experience some sort of a follow through over the next few days. If it drops back below, it'll negate the bullish breakout. Let's see the NASDAQ 100. Same thing, a little bit of a pullback, but still above that 4,480 support level. That needs to hold. Let's look at Japan's Nikkei. Oh, it's surging right back up again. See, it broke that uptrend line. It was climbing in a channel, and then it actually bounced right off 19,000. So that became a support. I was showing that support a few weeks ago. You can see it bounced right off there, but now it's experiencing or just coming up to prior resistance right around 2,240 or so. So that's the prior high that we saw in late April. I want to see if it can break above there, but for now it's in a trading range between roughly 19,000 and 2,200. Let's look at the dollar. Big surge today. This is very interesting. I was discussing this yesterday. This possible scenario is showing that there was an important resistance level overhead at the time. Now it's a support. You can see these lows back in January, February, and also more recently in April. Tried to break below there, but surged back above. So that negated the recent bearish signal for now. And you have this big surge in the dollar. It's because of the strong housing starts report that came out today. And that certainly punished non-U.S. currencies and also commodities because they trade inversely. So you can see pullback in the euro. Just want to see this support right over here. Actually, if you go back to late January, looks like it's right around 11,000. 1.11 seems like the support right here. Just want to see if that's going to hold or if it can break back below. big surge in the dollar yen. Very interesting, because I've been watching this wedge for quite some time. So I want to see if there's going to be a final breakout. And now you have the dollar strengthening a bit, and it caused the US dollar yen to strengthen. So I want to see if it can push above that wedge. Doesn't look like it's about to do it anytime soon, or at least the next week or so. But I want to see if it can break above 122. If it does, it could keep on rallying. So I'll be watching that. Let's see the British pound. See big pullback because of dollar strength. Same thing with the Australian dollar. Same thing with the New Zealand dollar. And what else? Let's look at dollar Canadian. There we go. Big bounce on dollar Canadian. It's because of the US dollar strength, and also weakness in the Canadian dollar because oil started breaking down again, which is a very interesting development. Let's take a look at what oil's doing. So I was saying that oil was struggling to break 60, or was just bouncing around right around that $60 per barrel level. Couldn't really follow through above there, and I was showing this uptrend line showing that oil was basically climbing in a channel, and then how it broke down because of the once again because of the dollar strength. So that goes back to the webinar I gave, the Cyber Group workshop I gave a few weeks ago on intermarket analysis, and you could see if you were following key technical levels in the dollar and you were aware of that inverse relationship, that this move in oil is no surprise to you. So I just want to see if there's going to be further downside. Let's say if the US dollar continues to strengthen, then most likely you'll see a further breakdown of oil. I want to see if it's going to break down below 58 now. It looks like the most important support. Actually, it's been a support resistance for quite some time, going all the way back to December. It was a resistance with this little pennant pattern. Same thing, this little pennant pattern back in April. Same thing with this most recent consolidation, but it was a support. So it really needs to break below 58 on dollar strength in order for it to retest the next support, which looks like it's around 54. It's really not surprising. I've been skeptical of this oil rally for a long time. I was saying the only reason why this is happening is because of the dollar weakness, not because of fundamental strength in oil, because there's a massive glut of oil. So it really makes no sense for oil to rally aside from forex correlations, basically, and that's exactly what happened. So now everything's going in reverse. I mean, it's still early, but I want to see if this trend has legs. All right, let's look at gold. Big pullback in gold, again, not surprising. That's because of the strong housing report today in the U.S. and also because of the surge in the dollar, and that was caused by the housing report. So it attempted to break out above 1220, couldn't do it with enough strength, and I actually said this yesterday for those of you who remember that it appeared that there were two concerning candlestick chart patterns that formed, which is a hanging man pattern and then also a shooting star pattern. So I wanted to see if there was going to be a downside confirmation, which we got today. So so far it looks like it rejected this 1220 resistance level, but I'm still watching 1220 and 1180 as important support resistance levels. So right now gold is back in that range, and that breakout attempt was thwarted. So do you folks have any other questions for me? Any other markets you'd like to take a look at? Any other stocks? I can look at them really quickly before introducing Vlad in 20 minutes from now. A lot of different markets out there. Seeing red across the board for commodities. Look at this. And this is really all the dollar. This is all because of the US dollar strength. See, look at this. US dollar strength causes this vast sea of red. It's incredible, right? All right. Let's take a look at TBT. 1 second. Let's go pull up another charting platform. That's the ProShares Ultra Short Treasury ETF. Let me just expand this. So basically, when treasuries go down, U.S. Treasury bonds go down, this goes up. So you can see right over here, it's been in a downtrend. 200-day moving average is moving down, but it recently broke above. Actually, I prefer to look at the actual Treasury bond chart itself, just because sometimes you get distortions with the ETF. So pretty much everything I say about Treasuries would be reversed just for TBT. Watch. Here we go. So you can see 30-year bond has been weakening significantly. And the reason why it was weakening was because of the rally in commodities. And it goes back to the inverse relationship that I discussed in my Into Market Analysis course. It's not because the economy is so strong. On the contrary, the economy has really gone through a weak patch lately. And that's why falling bond prices and also rising interest rates because of that has confused a lot of investors and traders. But this all goes back to that inverse relationship where commodities prices go up, bonds tend to fall. So right now, I'm just looking for support, maybe 150. I'm not really seeing any real obvious chart support right now. Maybe if we get back down to these lows seen last spring, right around June, July, and also mid-September. I'm not seeing any other real major support there otherwise. Let me look at the 10-year note now. This is on daily. Maybe 126, 125. That looks like a cluster of recent lows. But not really seeing any clear signal on this just yet. So pretty much whatever you're looking at here, just inverse it in your mind. That's what TBT or ultra short treasury ETF would look like, basically. So, and if you folks have any other questions for me, just shoot me an email at jesse@ctutrading.com. I love to discuss trading, and also if you're interested in doing personal coaching, one-on-one coaching, where I show you all different techniques for predicting the markets, forecasting markets. I have a lot of different ideas for that I can definitely share with you. And Rosa, Vlad, our presenter, will start in 15 minutes. I'm just doing my market update, and I'm going to go off the air for a few minutes, and then I'll introduce Vlad in about 15 minutes. So, all right, folks, see you shortly. Take care. Good afternoon, ladies and gentlemen. This is Jesse Colombo, Cyber Trading University's Forex and Futures instructor. And I'm very excited to have Vlad Karpel from Tradespoon on with us today. His topic's going to be called Key Trading Metrics, Return on Capital, Probability of Success, and Estimated Move. So he's going to be showing us how these key trading metrics make trading decisions much more clear. He's a 15-year trading veteran and also founder of Tradespoon. So he's going to be highlighting these critical elements of these metrics and makes the math very easy to understand. So thank you so much, Vlad, for coming on. I'm looking forward to the presentation.
Thank you, Jesse. Can you hear me?
Yes.
Excellent. So thank you again for the introduction. Thank you to the university for having me. This is the first event. And I just want to ask Jesse, is there any way for me to share screen in addition to...
Hi, Vlad. Sure, you can toggle between slideshow and desktop sharing. If you see the tabs right at the top, so you can go back and forth if you'd like.
Go to desktop sharing. Let me see. Start desktop sharing. Launch. Let me know if you can see my screen. Let me know if you can see my screen.
Let me see. One moment. Here, if you could just click on monitor.
Okay. Monitor 2. Okay.
Okay.
All right. So let's see.
There we go. I
Can
can
you
see it
see
now.
my screen?
Sure.
All right. So then I can just toggle it, and
Mm-hmm.
then I can come back to slideshow. Then
Exactly.
everybody can see this, right?
Mm-hmm.
All right. All right. Sounds good. So we can. Perfect. So let me start again. Thank you again, everybody, for participating in this event. Thank you to Cyber Trading for having me. And today I'd like to discuss key trading metrics: return on capital, probability of success, and estimated move. Before I begin, for those of you who don't know me, I was a executive vice president and head of technology at Options Express from its inception. I also work at several startups here in Chicago as a CTO. I have a master's degree in computer science, and for the past 15 years I've been building different models and algorithms to help me spot opportunity in the market. Also, for the past 3 years I've been teaching and mentoring Tradespoon subscribers on how to trade stocks and options using Tradespoon technology. So my passion is teaching, managing friends and family fund for the past 15 years using Tradespoon technology, and building quant models and programming. So some of the disclosures: options do involve risk and are not suitable for all investors. Prior to buying or selling an option, a person must receive a copy of characteristics and risk of standardized options. The information in this presentation is provided solely for general education and information purposes only. Any strategies discussed, including examples using actual securities and price data, are strictly for illustrative and educational purposes only. Okay, so now that we got that out of the way, in terms of the common obstacles, I'd like to begin the presentation kind of going over some of the challenges that I faced when I started trading. In order to be a successful trader, you have to be correct. You have to learn what stocks you're trading, or what underlying assets you're trading. Whether you're trading futures, or you're trading options, or you're trading stocks, you need to learn how the underlying assets behave from one cycle, whether it's earnings cycle or geopolitical cycles, to another. Once you feel comfortable with underlying assets, then the second step is to find the direction on the market, whether you're bullish or bearish. And then the third step is to construct the right strategy. If you don't do all those three steps and you don't have written trading plan, you can be correct on the timing and you can be correct on direction on the market, but the short-term volatility that we've experienced in the beginning of this year or in the past couple of weeks, where the market can go up 1% and can go down 1% in a matter of the same day, tend to trigger your stop orders and you lose money. So trading plan is very important, and that's what we're going to go throughout the presentation. We're going to mention how important it is to have a written trading plan with specific rules for entering and exiting positions. So at Tradespoon, we built a proprietary system to help us monitor all of the ETFs and stocks that trades on U.S. exchanges, and we are predicting where the stock is going to be in the next 50 to 75 days. We're following options expiration cycles, because if you're an option trader, if you buy it, you have to be correct on the timing of the options and the direction. Those are kind of two rules. You have to pick the right strike price, and you have to pick the right expiration months. So for option trading, because we have both stock and option signals, our options expiration is anywhere from 50 to 75 days, and that's our time horizon. So now I actually want to show you the outcome of our models before we jump into the discussion of specific strategy. Because as we said, in order to be a successful trader, you gotta, before you execute a specific strategy, such as option or future or stock, and you select the strike price, the first step is to actually find what stocks to trade. So now it's the desktop share. So monitor, let's see, monitor. So, all right. So I'm going to toggle back and forth between the monitor and the Tradespoon. So I assume you can see my screen. Yeah, perfect. So just let me know if you guys can't, and I'll stop. But let me see. All right, I think this is perfect. All right, perfect. So you can see the monitor. So if you're a Tradespoon subscriber, you can go under My Tools and click on Tradespoon Bulls, and it will provide you with the list of stocks that we have high predictability factor. And high predictability, what does it mean, high predictability factor? It means that for Netflix, Bristol Myers, or F5, we have two important numbers. One is the short-term trend that you can see on the screen, and one is the long-term rating. What do these two numbers mean? Long-term rating is kind of a traditional indicator that shows you based on the analysis of price action, earnings, discounted cash flow analysis, different fundamental factors. We are assigning a number 1 through 10. And we can, say I only want long-term rating 9 and 10. So this is give you an indicator how does the Bristol Myers or F5 compare to the other stocks across all the Nasdaq and New York Exchange. How bullish are we? 9 and 10 were bullish, 0 and 1 were bearish. Short-term trend is our kind of bread and butter of our analytics. Short-term trend, like for Netflix, this is a perfect example, shows you that we're predicting for the next 20 days, 30 days, and 40 days, and 50 days, following kind of options expiration cycle, that Netflix will be higher than it is now. F5 will be higher than it is now. So first step is to find which stocks to trade. Second step is to find the trend. So let's look at the trend for, let's say, F5. So this is a computer. They build firewalls and infrastructure for internet. So the second step, once we have a general bias that F5 is a strong buy signal, we want to find what is the direction of F5. And we can see going into June and July that, and in August, there is higher highs and higher lows we're going to make compared to where we are in May. What does this green line mean? This is a seasonality. Basically, we're looking for each stocks or for each ETF that trades on American exchanges, we're plotting the data for the past 25 years, and that's the green line. So we're seeing in June, how does the F5 behave compared to August? And from historical perspective, in August or in November, F5 trades higher from the seasonality perspective. So this is the first model that kind of gives us a trend going into June, July, and August. The second step is this orange line. And the orange line that you can see here, this is our prediction for the next 10 days, so shorter time horizon. If you're a swing trader or if you want to know what is the most optimal entry point for the stock, we're showing you that every time F5 approaches $123.50, this is a buy signal, right? It's a bullish event. And we're showing our predictions in the future. So this is our prediction for June 1st. This is our prediction for May 25th. Every time the stock approaches $128, $129, the blue line that you see, this is a short-term sell signal. We're bearish on the stock. So this is the second piece, which is very important. And again, we already discussed our 20-day prediction, 30-day, and 50-day prediction. So seasonal chart shows you three most important numbers. One is our bias for the stock. That's the 20-day and 30-day prediction. The green line shows you seasonality, where the stock is going to trend going into June and July. And then the orange line shows you what is the most optimal entry and exit point for the next 10 days in terms of support and resistance for the next 10 days. If you want to find more granular prediction, then you can go into our stock forecast toolbox. And this is a very unique tool that actually shows you not only stocks, but even indexes. So you can type in F5, click on Go, or you can type in index or currency or futures, depends what you trade. And you can actually see that in terms of our prediction for the stock for May 20th, May 21, we are showing that F5 is going to make new higher highs and higher lows. And that again gives us a sense of direction and what is the most optimal price to enter F5 position. So now that we have this direction, let's go back to the slideshow, and I assume you guys can see my slideshow. Let me know if you can see me and you can hear me. I'm new to this interface. I just want to make sure everything looks good. But now we're back to the PowerPoint presentation. So now that we have a direction of the stock and we have what stocks to trade, Thank you. We want to see how do you find the most optimal strategy, right? So we talked about seasonal chart, we talked about our short-term price prediction and different independent models that helps us to find long-term view on the stock like Apple or F5, and then short-term optimal entry point for F5. So that's the second step in the process, right? First step, you got to know what underlying stocks or currencies or futures to trade. Second step, what is the direction and optimal entry and exit point. And then the third step, which is very important, is actually building correct strategy. You have to execute correct strategy that gives you a higher probability of success. At Tradespoon, we recommend trading options, whether you're trading options on futures, currencies, or as stocks. Options are unique instruments. They're derivatives that depend on underlying asset prices, but this is a unique opportunity to increase probability of success and reduce your cost basis. For example, when we talked about F5, we said that you can buy F5 and the optimal point is at 125. But if you're able to buy F5 for 120 and buy F5 kind of at a discount, 2 to 3%, then you automatically increase probability of your success. So that's what I want to kind of talk about next. At Tradespoon, we have different strategies that we follow. One is the bull-bear call spread, and the second one is bear-put vertical spread. So we do two-legged strategies. We also provide you with trade recommendation. Every day we have a trade recommendation, and we actually tell you whether to buy an option, single option, or a vertical that consists of two options. So first, we have to look at the probability of success and strike price selection. So let's actually look through a specific example, and that will help us. Let's see, monitor 2. Perfect. So you can now see my screen. So under my tools, let's look at most recent pick. Every day, we provide you with the Tradespoon recommendation. I'm just going to give you a glance. This was the recommendation for today, Facebook. So we are able to provide you with a Tradespoon recommendation for Facebook. And then the idea is that we are providing you with a stock trade or an option trade. If you're if you're a stock trader, we tell you buy stock at $80.88. If you're an option trader, we tell you buy it at $6.85, the 75 call. That expires in July. Again, we're looking at the 50 days expiration. And the third step, we tell you to buy option spread. And notice the option spread, if the volatility is low, so we look at the volatility rank, that's the volatility change. If the implied volatility is relatively low after the earnings, Facebook announced earnings, and now the uncertainty about Facebook price action is low. Since the uncertainty is low and the implied volatility is low, in this example, we are buying a debit call spread. We're buying 75 call and we are selling 80 call. And notice that in this case, our break-even point is $75 and plus $3.55, $78.55, where Facebook is trading at $80. So roughly $2, we are buying Facebook with $2 discount. $2 out of 80 cents roughly is what? 2%, right? 2.5%. So we are able to buy Facebook at 2% discount. And if you look at the probability calculator, it basically shows you that every time you're able to sell options that are out of the money, so every time you sell 75 strike or you sell 85 strike, you're effectively reducing your cost basis. And by reducing your cost basis, you are improving the probability of success. So here you're looking at the probability calculator that shows that Facebook, looking at the underlying options data, that the probability of success for the next 50 days, the probability of Facebook reaching $88 is 78%, right? It says that Facebook will be between $73 and $88, and there is 78% probability of that event. There is only 12% probability that Facebook will reach $88, or there is only 10% probability that Facebook will reach $72.91. So if you're an aggressive options trader, you can actually sell, let's say, 73 put or 75 put, and you will have, and there's only 10% chance that it will drop below $73. That means that 9 out of 10 times you will be correct on this trade, and you will make money 9 times out of 10 as long as you sell in 73rd put. Obviously, selling naked options is geared only toward active traders that are more experienced. If you someone just wanted to get exposure to the options, I would recommend doing the spread, and that's why we actually provide you with a spread trade. And notice that we tell you at what price we buy it, and if there is any hedges or any correction to the trade, we also tell you every time we get filled. Also, the important part is to see our video. If you're new to options or you want to learn about options, we provide you with the instructional video. So every day, May 19th, May 18th, May 17th, we provide you with the video, and you can type in, if you type in the password, you can actually see our video that describes you how we follow our Tradespoon technology to find the most optimal trades. But we also show you step-by-step process we just covered recently, how we found this trade. And we are managing every trade in a real trading account. We have a partnership with Trading Block, where we have a marketing relationship. But we open a real account at Trading Block, and we're placing real trades like Facebook that you see on the screen, and we're explaining you how we selected the strike prices and how we build the highest probability of success. So this video is instrumental in helping you not only learn how to trade options, but they also can help you understand how we use the technology to come up with some of these trade recommendations. So let's switch back to the slideshow. All right, so now you can see my slideshow. Perfect. So now let's see if I can draw the pen. There's lines, freehand writing, pen. Okay, so let's just go over the probability of success. So in this example, we're looking at Edward Life Science, but trading options or trading futures or options and future follows statistical analysis. It follows the probability of success. You see here that this is Edward Life Science, and currently it's trading at $131.57. If you trade in options, you have to ask yourself a question, or if you trade in stocks or indexes, you basically have to say, by a certain date, which is 50 days from now, what is the probability that Edward Life Science will reach $150? And that's this line. So what is the probability of Edward Life Science moving to 149 or selling off to 113? And you're basically saying that this is a 1 standard deviation probability, right? So this is, this is fun. So this is 1 standard deviation, going back to our statistics class. What does it mean? That roughly 68%, or because the implied volatility is a little bit bigger, but probably roughly there is 75% or 68% probability that Edward Life Science within the next 50 days will reach 114 level or 150 level. So why is this important? It's the same thing as kind of going back to your statistics class and rolling 2 dice. If you roll 2 dice, right, take your 2 dice, you roll them, and each dice has 1 through 6. You basically have to ask yourself, if I roll this 1,000 times, very often, if I trade often and I trade small, or if I roll dice over and over again, what is the highest number that will come out? Which number will come out most of the time? And you know, statistically speaking, 7 will come out roughly 18% of the time. Okay, so 7 will come out 18%. 6 and 8 will come out a little bit less often. So 6 and 8 individually, each one of them will roughly come out with 14% of the time. Okay, so that's back in statistics class. Trading is the same way. So for dice, if I want 55% probability, let's say, right? If I want to be correct 55% of the time, if I want to be correct 55% of the time, roughly, then I would trade 6, 7, and I would pick 6, 7, and 8. I would pick 6. I would pick 7. And I know you guys have questions. This is great. Do me a favor, I will try to go through the entire presentation in 30 to 40 minutes, and then I will make sure that I answer all the questions. I do actually want to go over the offer that we have for Tradespoon technology and tools, but I also want to answer all of your questions. So please type in your questions, and I'll make sure I'll answer them towards the end of the class presentation. So 6, 7, and 8 will come out 55% of the time. If I want to, but flipping the coin is 50-50. Is also a binary event. It can go up or it can go down in the next day or next 5 days. You don't really know where the stock is going to go. For options, if you want to select, if you want to be right, let's say 70% of the time, right? And that's kind of what we're striving. We want to be correct. Out of 3 trades that we do, we want to be correct 2 times. So 67, 70% of the time. So if I can build a trading plan where I'm 70% accurate, and for every 3 trade, 2 I will make money and 1 I will lose money. And as long as I'll make sure that the losing trade, the amount during losing trade is equal to the amount of winning, then you know that basically 2 trades will break even, but 1 trade will always make money. So, and as long as I trade at least once a week or a couple times a week, and I trade small, I only put 5% of my portfolio, that's my trading plan. As long as I put 5% of my, no more than 5% of my money into each trade, and every time I trade, 1 out of 3 trades I'll make money, and 2 will be just breaking even, I can slowly I will slowly make more and more money. So if I want to be 70% of the time, then I will choose more numbers, right? I will have to involve 5, I will get involved 6, 7, and 8 and 9. So the point is that if you trade options, it's the same kind of way. You want to, if somebody asks you a question, if you roll your dice 70% of the time, what numbers will you get? You need to, well, basically it's based on statistics, it's 5, 6, 7, 8, and 9. If you want to say how often will 1 and 1 come out, well, that's only 1 out of 36 times. So do you want to say that during next roll you will get 1 and 1? Well, the chance is very small. This is the point of options. If you, in this example, if you want to buy 150 call, let's say, right? Stock is trading at 131. If you want to select a strike price 150 and buy a call, well, you can make money, but it's only 10% of the time. So 9 out of 10 times you will lose money. So selecting the strike prices is very important to make sure that the probability of success is on your side. And when you trade options, when you trade stock, you want to select a strategy and select the strike price that gives you probability of success 70%. So that means, especially when you're a new trader, you don't want to select 149 call. You want to probably select 115 call or 120 call because you know 90% of the time this call will be in the money. So, and the opposite is also true. This is when where you long. If you're long, then you select 113 call, right? But if you selling, if you're shorting an option, then you can select, 113 put and also make money. And that gives, because this way you 90% of the time you'll be accurate. So part of your trading plan that we started this conversation, you always want to make sure that whatever strategy you design, you want to have a simple strategy, one strategy, 2 strategies. You don't want to design different, have 10 different strategies, but you follow one strategy, whether it's an option or a stock or an option spread. Those are probably the easiest to learn option strategies, and you just follow it methodically and always trade the same strategy to make sure that the probability of success is on your side. Okay, now I have to figure out how to delete all clear page. Perfect. Okay, great. So that's probability of success. That's a very important concept. Second is implied volatility rank, and why implied volatility is important. Implied volatility is important because when do you, in the previous example, do you buy put, or do you buy call, or do you sell put? Do you buy debit call spread, or do you sell debit call spread? Well, you know this based on the IV rank. So implied volatility, for those of you who never heard of implied volatility concept, I would think about it's a measure of how much underlying asset moves. You know, if the underlying asset moves a lot every single day, then implied volatility is elevated. Or implied volatility is high when there is a binary event. If there's an earnings tomorrow for this stock, then implied volatility will be elevated because nobody really knows what will happen during the earnings. So when implied volatility is high before the earnings, then you sell the premium, right? You will sell put or you would sell a call, right? Depending on what your view on the stock. You know, if you're bullish, you would sell put. If you're bearish, you would buy call. So if you're bullish, you sell put, right? We'll just give one example. So if you sell put when you're bullish, right? But you do it when implied volatility is elevated, right before the earnings, or right before a geopolitical event, or while geopolitical event is happening, uncertainty is elevated, you sell puts. When stock announced earnings like Apple and uncertainty is low, implied volatility is low. If implied volatility is low, this is when you buy options. Because they're cheap, right? The options are insurance, like insurance on your house. You want to buy insurance on your house when there's no uncertainty in the market. If you live in a hurricane area like in Miami, and in September when there is a high chance that hurricane will hit Miami area, you don't buy insurance in September because your premium will be elevated. You want to buy it in, I don't know, January or February when it's nice and shiny outside and there's very low probability that the hurricane will hit Miami. So insurance will be cheap. So same analogy. So you buy options when there is very low volatility. And if you're bullish on a stock, like F5 that we said, or Netflix, then you would buy call, right? So you would buy call if you're bullish. So it's very important. If you trade in options, before you actually commit real money into options, you want to understand two things. One is you want to understand probability of success. You want to design a trading plan where you're 70% accurate. And you follow a strategy that gives you a yield of 70%. So understanding how to derive probability of success based on underlying options data is a very important key concept when you trade options. So that's the first rule, probability of success. The second rule is you got to study implied volatility of the underlying asset that you're trading. So you pick your favorite stock like Apple or Netflix, or you follow Tradespoon technology that tells you, this is the most optimal stock to trade based on liquidity, volatility, and predictability of the stock. And then once you pick the stock, you got to know where it is in terms of the cycles of implied volatility. You buy in options or buy in debit spreads when implied volatility is low, and you sell in options when implied volatility is elevated. So those two concepts you got to understand either intuitively or mathematically from statistical point of view, and only then you can commit real money. If you still don't understand what probability of success or what is implied volatility, you do not want to commit real money into trading. You kind of want to do it in virtual environment and just learn from someone or a service or from who can teach you these concepts before you commit real money. So let's hold on, delete. All right, so let's move on to the next slide. So math behind. As you get more comfortable in terms of your understanding of probability of success and implied volatility, those two rules, right? One is the probability of success, and one is your implied volatility, this volatility change, right? Those are the two things that you want to be comfortable with. And we are providing you with this, for Tradespoon recommendations. But you need to understand that higher probability of success means low return on capital, mean higher risk. And this is what option trader and market maker are doing. People who trade options for a living, and that's their full-time job, they are trading high probability of success. They would argue that instead of being correct 70% of the time, I want to be correct 80% of the time, 85% of the time. All that means is that you buy in stock at a higher discount. You move in, instead of buying Apple at $130, you buy an Apple at $120, $115. You basically sell an option premium out of where underlying stock is trading. So in this example, if Edward Life Science is trading at 129 and I want to be correct 8 out of 10 times, I would sell, a strike price, let's say 115, right, roughly, hypothetically 110. And delta can be a good proxy. You know, when you learn about options, you learn about Greeks and delta of 20, right? If you trade options with delta of 20, all that means it's a proxy for your probability. That means 8 out of 10 times I will be correct. So professional traders, they are moving away from where the stock is trading. And you know, if they have directional bias, they will sell put. If they don't have directional bias, then they'll sell, you know, counters, or sell call or strangles. They'll sell the short put and they will sell a short call. If you're new to trading and you do not want to take high risk, because if the stock does trade sell-off in this example, and let's say I was wrong and it actually reaches 110 level, for the amount of premium that you collected, it doesn't warrant the amount of risk you're taking. So unless you know how to aggressively defend your position when they go against you, you do not want to take high probability of success trade. You want to have lower probability of success, such what we do at Tradespoon, not low but lower, around 70% or 60%, but you know that you have a higher return on capital and you can withstand the volatility in the market easier. All right, so let's go through the math. First, we want to go through return on capital, and we'll do this quickly, and then I'm going to show live examples. So one is return on capital for credit spread. If the implied volatility is elevated, and you want to sell, you know, iron counter, as Humphrey mentioned, you know, selling call spread, selling put spread, or if you directionally bias, and on this example for ticker ROC, for example, or ticker, sorry, TRW, if we're bullish on TRW, then you want to sell, let's say, a put spread, and that's what you see here in the example. We're selling a put spread. We're selling 70 put. We're buying 67.5 put. How do you calculate return on capital? And why do you need to recalculate return on capital? You need to calculate return on capital before you get into a trade to follow your trading plan. If, like we said, we are correct 70% of the time and we're making 2 out of 3 trades correctly, then you need to decide how much money do you want to make on each individual trade, and you just have to be consistent. So if you want to make 20, if you want to hold your position, let's say for 20 days, at Tradespoon we have a trading plan where on average we hold our position 20 to 30 days. And we are targeting 30% return on capital. So if I can, on each trade, make 30% return on capital in 30 days, that's, you know, that's a great strategy, right? You can make 30% of your money in 1 month, as long as you have more winners than losers. So we're basically saying, okay, let's be concerned, you know, but that's an individual trade. We always keep 50% in cash or 40% in cash. So that means if I do want to generate, let's say, 5% return on capital, statistically, I just need to generate 30% return on each individual trade. So we're looking for 30% return on capital. That means we need to know how to calculate this and how to set the limit price, our target gain orders, in order to reach that target, that limit price. So on credit spread, the maximum gain is the ask of the buy leg minus the bid of the sell leg, right? So here we're doing a credit call, a put spread. We sold 70 put. We bought 67.5 put. The difference between $1.90 and $1.10 is 80 cents. That's our maximum gain, is 80 cents. It's the difference between these two numbers. And the maximum gain, or the maximum loss, is the difference in strikes. You take the difference in strikes, you know, 70 strike and 67.5. That's 2.5. You subtract 80 cents, and that's $1.70. And this is how you calculate the maximum gain and maximum loss on this trade. So as you put on this trade for 80 cents and you're looking for 30% return on capital, okay, so then 30% of $1.70 is roughly 60 cents. So you basically want to close this trade when you reach 20 cents or you reach 30 cents. All right. So how do you do this for debit spread? Very similar strategy. Unlike credit spread, debit spread, you execute again when implied volatility is low, and you pay money up front. Credit spread, you receive money up front because implied volatility is elevated, so you're getting a lot of premium for your options. But if you're not getting a lot of premium for your selling your out-of-the-money options, then you buy, basically. You buy a debit strategy. And here's a debit call spread. The maximum loss is the premium that you pay up front, right? It's the ask of the buy leg, and the bid of the sell leg, right? So 380 minus 650 is 270. That's the maximum you can lose. Spreads allow you, if the stocks don't move a lot, like after the earnings, you know that there is no uncertainty in underlying stock, like FedEx, when it announced earnings, I don't know, 3 weeks ago. Following that, FedEx will not move more than 5-10%. If that's the case, if it's not going to make a rapid move to the upside or downside, vertical spreads is the most optimal conservative strategy. So the maximum loss you can sustain is $2.70. It's the difference between your buy and sell leg. And maximum gain is, again, difference in strike prices. You take the difference in strike prices, 160 minus 155, that's $5, minus your maximum loss, 270, so your maximum gain is $2.30. All right, the second concept is the estimated move. Right, we talked about return on capital. We talked about volatility change that we provide for Tradespoon recommendation. We talked about probability of success. Now we want to talk about estimated move. Estimated move, why is this important? Estimated move can show you direction. If you're, if you look at your chart of the stock, stock moves like this. Oh, sorry, that's a bad drawing. I'm having difficulty. Why is this not working? Clear page. Okay, perfect. Sorry. So if you've seen a stock, all right. If you see how the stock moves, right? You look at the chart, and let's say stock is right now trades here. Estimated move basically allows you to, using options data, predict the range of stock movement. So that's the estimated move. So if the stock trades right now, let's say this is FedEx, and it's traded in at 178, right? Right. So if you want to know by next expiration date, let's say in 50 days, so you can follow weekly options, where the stock is going to trade, you can use this estimated move formula to see where the stock is going to trade. And $4 meaning that once the FedEx will trade in 182 or as low as 174. It doesn't give you directional bias, but it basically tells you that the stock will trade between 174 and 184 based on estimated move. That's why estimated move is important. If you're a stock trader or an option trader, it doesn't matter. Or if you're a future trader, every time you have if you have options on underlying asset, you can look at the demand and supply for at-the-money options by certain expiration date, and with high certainty figure out what is the range that the stock will move. How do you do that? Well, here's the one formula, as an approximate formula. You basically, if the stock in this example trades roughly at $38.50, you take at-the-money strangle, and you take out of the money, you take at the money straddle, and you add at the out of the money strangle. So you add 209, right? This is the calls. These are calls. These are puts. So you take 209, you add 277, right? You take at the money straddle, and then you add to it out of the money strangle, 151 and 164. You take that option data, and this is your confidence interval. Yes, thank you. So it basically helps you to predict what is the price movement of the underlying asset by the expiration date that you're reviewing the option chain for your options. So that's very important. Okay, so we started with return on capital, and when I finish with return on capital, let me go back to the desktop sharing. All right. All right. So we want to cover, we talked about estimated move. So on Facebook, let's talk about that quickly, since I have to tackle between two screens. But to review estimated move, For Facebook example, it's $4.10. How do we do this? We looked at July 17 expiration options, and we basically added the at the money straddle and at the money strangle, and we come out with estimated move $4.10. What does that mean? If you look at the chart and you see that, sorry. Well, this is the wrong chart. Let's look at another example. Sorry. Let's look at Nucor. I have the right chart. Sorry, yeah. So Nucor. So this was the recommendation from 2 days ago. So we shorted Nucor, and estimated move was $3.70. So what does it mean? If Nucor Corporation trades at $49.32, which is roughly $49.32, roughly here, around 32% Fibonacci retracement. So the estimated move of $3.70, meaning that in the next 50 days, Nucor will reach as low as $46, kind of a 68% retracement, or it will make new higher highs and reach roughly $52. That's kind of gives you that confidence level, the estimated move. Now let's go back to the trading plan. So at Tradespoon, we provide you with, daily recommendations, such as Facebook or Nucor, accompanied by instructional video, where we give you a choice to trade options or option spreads, and we send you instructional video and provide you with real-time SMS messages and email explaining you at what point to get into position, get out of the position, or if the trade goes against us, how to adjust the trade. Then we're showing you full transparency into our trade. Every trade that we make, we're showing you whether we made the money, such as the trades in green, or trades in gray where we lost money. And our goal is to be 67% accurate. So if you look at how many winning trades, and the trades that we do in real portfolio that we show to our members, we're doing option spread trades. But if you're not comfortable, you can do options or stock trade. And we're showing you that, statistically speaking, option spread, we're returning 60% across winning and losing trades. If we do option return, it's less, 10%, and if you do stock return, it's actually 9%. If you use the stop price for stock trade. What does it tell you? Hopefully, from this presentation, you can actually intuitively agree that it doesn't matter who trades. If you do it very often, you can always have an outlier, but if you trade since 2012, this history goes back to 2012. So if you do, here we did 630 trades. If you do this often enough, the spread trades give you a better results. Why is that? Because if we go back to our Facebook recommendation, we saw that our break-even point is at $78.55. For stock traders to make profit, it has to be above $80.88. And for option trader, it has to be above $81.85. So since the option spread gives you the lowest cost basis, intuitively, it makes sense that the option spread trade strategy will actually give you better results and give you higher statistical chance that you will make money. If you are actually selling naked puts or naked calls, you will get even higher return across all your trades. But you're taking, bigger risk. That's why we feel option spread strategy is the most optimal strategy. So hypothetically speaking, if you open up an account with $10,000 and you allocate only 5% per trade, like we said, $500, and you are 70% accurate, right? If you take 223 and divide it by 623, you'll see we're losing money only 30% of the time. 70% of the time we actually have successful trades. And on average, if we make 20% on average across the trades, 20% of 500 is $100. So if you get $100 per trade, and we actually did this backtest, that basically shows you if you start an option trade and you trade every single trade and you follow the rules where you allocate 5% of your portfolio per trade and you participate in every trade, Again, this is a backtest. This does not take into consideration commission or slippage, full disclosure, but it shows you what your trading plan will look like. Where if you start with $10,000 December, you will end up with $35,000 in May, or $55,000 if you trade spreads. The idea here, this is a backtest that shows you that on monthly basis you can target 5% return per trade, roughly. Anywhere from 5 to 4% return per on monthly return if you build a trading plan. And the reason we show you the performance, we want you to be comfortable with our strategies, but ultimately all of us are different, and we have a different amount of money we're managing, and we have a different risk tolerance based on our background. So the idea here is to learn our strategy and adjust these numbers. When you go Harley Davidson, as we recommended on May 11th, when we provide you with our recommendation, we basically give you a video and we tell you we're looking for 30% return on capital. But if you're new to trading, you might say, well, 30% is too aggressive. Maybe I will target 15%. Or maybe instead of selling, options at the money, I will sell options in the money and kind of use these two levers. Maybe I'm looking for higher probability of success or less return on capital, or less probability of success and less return on capital. So that's kind of the goal of our platform. And we do have questions. I want to get into the question. But before I do that, I do want to go over the webinar, the deal. So hopefully you guys learn from this presentation. I think if you want to learn about how to trade options, or if you already know how to trade options, but you want to have a consistent trading plan that you can follow and generate, depending on your background, whatever the number you want to generate, you can enroll into our, you can go to this Tradespoon.com CTU deal. And let's see, can I send it to everybody? Send. General chat send. Okay, perfect. I think everybody can see it. Tradespoon.com CTU deal. So you can see it here. So for $67 a month, you basically get, our regular price is $97. So you get 30% discount because you spend an hour with me learning about options. Seems like you do have an interest either learning options or become more successful trader and improving your statistical probability of making more money and be more successful. So we're giving 30% discount for $67 a month. Not only you get access to all of our tools, but you also get access to our commentary, right? We talked about the focus list. We talked about the seasonal chart. We talked about the stock forecast toolbox. So you get access to all these tools, but the most important, you have access to our recommendations, and every time we send an order to either hedge or close, we actually tell you. We send you an SMS message, and we tell you exactly how to hedge your position or at what point to enter or exit this position. We tell you what the fill date is and what is the price that we're looking for. And we're giving you a video, so you can actually follow step by step of how we execute this trade and how you can reach these target gains. And if you look at our video, it's actually done in real life account that you can follow. So hopefully you can guys take advantage of this offer if you want to learn about options or if you want to get access to our tools. And actually, if you click on enroll now, you get it's $67 a month, or for $497 a year, you get 40% discount if you want to get higher discounts. So let me now get to your questions. Okay, Joseph, do you have managed account? So let me go here. So full disclosure, I went through disclosure before, but Vlad Karpel is also an employee of AOS, an investor at AOS, which does business as Trading Block, which is a registered broker-dealer, FINRA SIPC member. Two companies are not affiliated companies. I am not a registered advisor. But Trading Block and third-party vendors may have marketing arrangements. So now that we do have full disclosures that you can read again in the footer of our site, we do have an auto-execute service. So if you go under platform and manage auto trading, I encourage you to take a look at this. And you have you can save up to 70% on your commissions. But B, if you open up account with Trading Block, we can auto-execute these trade recommendations. If you want to have a register rep assigned to you, you can also do that if you visit a Trading Block. So thank you for that question, Joseph. In terms of this offer is good for 24 hours. So if we will send an offer at the end, and along with the recording. So this is an offer only if you are part of the webinar, and you want to take advantage of this within the next 24 hours. How do you adjust a losing trade? So how do you adjust a losing trade? Let's look at the example. Let me see my tools, open positions. Let me see some of the trades that we did adjust. Dow. So let's look at Dow. So Dow Chemical, we made the recommendation on April 24th. Since then, if you look at the chart, stock is trading in a sideways range. And if you look at our predictive analytics, let's look at it here. If you go to Stock Forecast Toolbox and actually type in Dow Chemical, when we made the trade recommendation, the stock, the trend was to the upside. Now we're seeing kind of the stock is trading in a range between 50 and 51, and we feel like in the next 10 days the range will not be broken. So how do we adjust this trade, or how do we hedge this trade? Yeah, so what we did is, we bought the debit spread at $1.90 back in April 25, and now we're protecting our investment by selling out of the money options. So we're selling 55 call and 60 call because we feel like, if you look at the stock forecast toolbox, we are not breaching the 52 level. So we're selling 55 call and collecting 23 cents. And 23 cents, on a $1.90 investment, that's what? 10%, right? Over 10%. So we're basically able to reduce our cost basis by 15%. And we will do this several times. And we send an SMS message, and we will send you an email telling you exactly what we did in our real account. And you can actually see the video how we did this here. But we send you an SMS message because for a lot of people this is not a full-time job, so we do want to make sure that you get a chance to look at this trade. And here's an example where we sold it for 23 cents and we bought it back for 10 cents, so we made 13 cents, and now we're initiating a new position and selling it again for 24 cents by doing weekly options. So thank you for that question, and it's a very important part of our process is to teach you how to aggressively defend your position. And as you get more experience with option trader, then you can take the higher risk trades, which we actually do provide like a bonus strategy, earnings strategy, where we have an earnings play, and then you can do a higher probability of success trade. So Stephen, another question: if cancel, will you prorate? Yes. So, let's say you don't like the service, it doesn't fit your trading style, or you go on summer. Yes, you can sign up for $497 and then send us an email saying, listen, I'm on vacation, can you at least prorate my membership, and we will prorate your membership. Trading spread will often have a max loss, perhaps 4 times higher than max gain, and therefore being 2 of them may not. So Stephen has a great point. Depending on strike prices, trading spreads will always have max loss, perhaps 4 times the highest than maximum gain. Therefore, being 2 out of 3 times may not be enough. And that is the great. It's a great point, and this is what we hopefully from this presentation you will see. So, like for example, for Dow Chemical. In here we are risking $1.90, right? But we're closing the trade where we are making 30% of the risk. So when we reached 70%, 30% of $1.90, that's roughly 70 cents. So in this case, example, being 2 out of 3 times is correct. But if you're a more aggressive trader, you can actually sell, let's say 47.5 put, right? And being 10% of the time. That's the whole point. If you're taking higher probability of success trade, 2 out of 3 times is not enough. You have to be right 90% of the time, right? If you constantly trading and selling, let's say you take all the bullish trades like Dow or Facebook or F5, and you selling 46 put consistently, you selling 10% out of the money puts with delta 20, delta 15. Being correct 2 out of 3 times is not enough. You have to be correct 10. You have to be correct 80% of the time. So that's the lever. That's the lever that you want to consider, and that's what we teach during this instructional video. You have return on capital and you have a probability of success. If at Tradespoon, we are happy with being correct 70% of the time or 65% of the time because our return on capital ranges from 30, 20 to 40%. But if you're trading out of the money options, your return on capital might be only 10%. Right? So if your return on capital is only 10%, your probability of success has to be higher. These are the only two levers that you have when you trade options or stocks, right? There's no, what's the right expression? There's no free lunch, so to speak. What does that mean? It means that you can be right 90% of the time. All it means that your return on capital will be less, right? Higher. If you take a trade that have high statistical probability of being successful, all that means that you're taking higher risk. So you do see a lot of services where they would say, oh, I triple my money in the past 2 months, or I made 300% return in the past 3 weeks. This is great. And I'm not disputing whether it's true or not, but statistically speaking, all I know is that if they made 80% return in 1 month, all it means that they traded high probability of success trades. When Dow trades at 51, they sold 40 puts, right? And if they got into a bullish range of stock market, then yes, they can make that money. But all that means is that they may be collecting 10 cents on that option or 20 cents on that option. And as long as they're correct 90% of the time, they will make money. But at one point, Dow might sell off and reach $40 in a matter of a couple of days. Then it becomes your experience. If you know how to defend these trades correctly and aggressively, then you can make more money. But if you don't know how to defend these trades aggressively, you could be correct nine times out of 10, and during that one time, you will lose more money that you collected in the previous 9 times. That's what you want to avoid with this high probability of success trade. That's why when we teach our community, our subscribers, we're starting better than flip of a coin, right? We don't want a 50-50 chance. We want 60-70% probability of success, but we are getting higher return on capital, right? We can get, we can double our money on this specific trade for Dow Chemical as long as Dow, reaches $51.90. So this is a very important question, and thank you for that question. So we are at 4:30, 4:29, maybe 1 or 2 more questions, and I think we do have to wrap it up. Under my tools, you can always send me an email. If I don't get to your question, just go to technical support, and I'll be happy to answer any questions that you might have if I didn't get a chance to answer all of them. Again, take advantage of our special deal, and let's see what else. You guys are a great audience. I do have a lot of questions, so it's great. I don't know. Are your status coming from? So what is your secret sauce? That's the question. I think secret sauce is this. Traditionally, there's a lot of newsletters and services out there, and there's a lot of market makers, ex-market makers that are trading and showing you how they trade. And a lot of them make money, right? But they're professionals. They've been floor traders on floors of different stock exchanges. They've been trading for years, and they know how to make money because they are taking advantages of discrepancies in implied volatility. They look at how much uncertainty does the market have a view on the stock, and what do they have the view of the discrepancy in implied volatility, and they structure these trades with high probability of success. And as long as you don't have a binary event like a rapid sell-off in the market, you'll make money. But most of the traders or most of the retail investors that we are targeting, they're not they haven't traded on the floor for 5-10 years. They're not day traders. to be a successful day trader, to be a successful market maker, you gotta have the right not only tools and techniques, but also managing your psychology. That's why 90% of day traders actually lose money, because you're trading against high frequency trading, you're trading against professional traders. So our secret sauce is that we use analytics. We use predictive analytics that help us with strike price selection. Like in here, we actually see that we're showing you a clear picture that our prediction going into the June is that Dow will not breach 52 level or 52.5 level, or it's not going to sell off below 48. And we're giving you directional bias, right? We tell you that we're bullish on Dow. Where traditional services, they always sell credit spreads, and they always sell out of the money credit spreads, and they basically even say, like, we don't have an opinion where Dow is heading. We don't know where Dow is heading, but we're comfortable with selling 48 put. Where our secret is so that we actually, by removing binary event, we are predicting a trend. We're predicting whether the stock is going to go up or down, or trading sideways. And we have very sophisticated, analytics using neural networks and modeling that help you find that direction. So I think I answered most of your questions. If you do still have questions, please go to upcoming web. We do have upcoming web where you can go to technical support and send me your email. I hope you guys take advantage of our offer. And I want to say thank you to Cyber Trading University for having me. You guys been a great audience, and hopefully I can have an opportunity to present again. I want to say thank you to Jesse for having me and helping me set up the environment and help me to present. And at this point, Jesse, do you have any questions, or is there anything else? I hope you guys can hear me. Jesse? All right. Thank you for a good lecture. Well, yes, seems like a lot of you guys can hear me. At this point, if you guys have more questions, let me know. I'm not sure where Jesse is, but it's it is late. It's 4:33. It's been an hour. If you do trade options, make sure you understand probability of success and implied volatility rank. How implied volatility now relative to historical implied volatility that we covered today. And if you want to trade or learn how to trade, go to this offer. And I think if you're ready to trade options or learn how to trade options, I think this is a great platform to do that. Thank you very much. Thank you for your feedback, and have a great day. Thank you. Thank you, guys. Trent, Ray, you guys have been a great audience. There's a lot of people, so thank you for giving me the opportunity to present. And yeah, if you guys have any questions, email it to me, and hopefully you're gonna be, now you have tools and understanding how to trade options.